All right, welcome to this week's episode of Build Value by Choice. I am your host, Nana Bonsu. I am the president and CEO of Infinite Horizons Incorporated. Our website is www.infhorizons.com. We help business owners increase the value of their business so that they can execute on any transfer option that they want to, whether they want to pass on their business to their kids or whether they want to sell outright or whether they want to just bring somebody into the business so they can go into the boardroom. This week, every week we talk about different topics related to business owners. This is essentially your board of advisors. And this week, we are going to be talking about the process of selling your business. I have with me a distinguished guest, Krystof. Krystof is a business investor. And he focuses on building, growing, and turning around businesses. He's a global investor, and he has investments in the UK, in Europe, in European Union, and also in the United States. Welcome to the show, Krystof.
Yeah, thanks for having me. Thank you.
Wonderful. Now, I know that you have we did a previous episode, before, and we talked about this whole process or your philosophy in investment and whatnot. This week, I wanted to get a bit of a walk through the process, because right now I know that you're looking to invest in companies, in businesses, and
yep.
I thought this was timely for business owners to just hear from you from the external perspective, right? What do you look for in a business? What are you looking to buy? What are some of the types of businesses that you're looking to buy? If we can start from there, that would be great.
Yeah, sure. So as we discussed privately, there's a lot of things going on right now because I bought another business in Europe, which was in the constructions and turning into development company. And together we put a great partnership together to grow both businesses and buy other businesses. So I still would say that I'm sector agnostic in terms of buying businesses, but definitely I have some preferences in terms of the locations and the sectors that are more strategic acquisitions for things that we do already. So I believe last time we have discussed that I am looking for the sectors I'm most interested in are business services, especially the core ones like marketing, HR, PR. It could be accounting and law companies, but they're a little bit harder to purchase because I'm not accountant, not a lawyer, and things like that. And because of the construction deal, we are also looking for construction companies and property management companies. So I would say that's like a biggest focus. And then there's like a lot of other businesses that could be interesting around. So we don't decline any. In particular, if somebody is looking to sell their business and feels like we could be a great partners, we will value their business and give them our offer. Mm-hmm. But these are the businesses that right now we are more focused on, because it brings us more things that we want to do in the future. In terms of the size of the businesses, we look, the sweet spot will be between like $1 to $10 million of revenue with the minimum of $100,000 in profits in EBIT, just to make it sense and be able to grow the business a bit. So that's I would say like the major criteria that we are looking to do right now. But we still do the turnarounds. We still do the IPOs. We still do helping businesses to grow. And if we buy just a portion of the business, to use our strategies that we use with all the businesses that we have to grow them massively, so they are more valuable, have more cash flow, more profits, even are bigger, and to help that. So this is the core right now, because we are setting a fund to be able to do real estate deals and also buying businesses, and we will attract much more money in the months ahead. But yeah, still open for a lot of things. But yeah, I would say that's like a good a good start in terms of what we are focusing on right now, because it changed a bit over the last 6 months or so.
How so?
Yeah, because of the deal that we have done, the construction company, it brings the talent and the skill set in the construction, and right now, because it's in the Europe, particularly specifically in the Czech and in the Spain, we are looking to buy specifically the construction company in the US, so then we can invest the money in the US as well. So that's the one. And then because the construction company raised a lot of capital, and we decided to create a fund around it. We will work much more strategically in terms of being able to open the new spaces that with the construction company. Then we can do development deals for the construction company as well, and invest money in even like a wider geographic area. So that's probably the biggest reason. I'm always working strategically and long term. So based on the things that I have right now, I always look for specific deals that would enhance the value of those businesses that I already have, and we do it for every single business. So if we buy a construction company in the US, we will definitely look at subcontractors and maybe other companies that are in the same ecosystem, maybe clients, maybe suppliers, maybe competition that we can bolt on to grow the business to the next level. So it's always changing, but this is the focus right now.
And what returns are you looking for?
Can you specify like the returns for because we have like revenues and profits, and from that point we are able to give like a specific offers. Then we all generally, like in these businesses, we usually look at 3 to 5, maybe 6 times multiple. If it's like over 5 million, it will go higher, but that's the usual things. But we are valuing the businesses based on the multiple, not which you can recreate to make like a percentage return, right? But that's it. And from our investors that we have in the fund and work with, and financiers that we are bringing to the deal, like asset-backed financiers, SBA loans, other investors, sometimes even other private equity companies, then we need to make sure that the deal works for everybody, right? The seller,
right,
for us, and for all the partners. But so it depends on what. Sometimes we will do acquisitions just to get some resource that is not monetary. So if they have the customers, the clients, which is the same, I mean the employees, or other or premises, or in the different sectors, we don't need to have a lot of return at the moment, because there are other assets that we are looking to strategically acquire. So it's hard to tell specifically, but from perspective of what we are willing to like offer, and the multiples and things like that. But I always say that the business valuation is not just about the price; it's a lot about the terms as well, and it will always change based on the quality of the business, in terms of how much value is in the business is linked to the business owners. You know very well that a lot of times it's basically most of it. So that business is it could be valued very well, but probably that we will not get a lot of cash up front, because there's a lot of risk involved. Some businesses are really great, and they should get a lot of money up front, and it depends on the assets of the business and things like that. So maybe we will discuss how we structure, how we move like in the process. If somebody is looking like, hey, seems like Krystof is a good guy, I would like to sell, like how it works. So in that sense, we can talk about if somebody wants to sell to us, how we will move the deal forward.
Right. So how does a business owner know that, know if they're ready? Because a lot of times it may not even be in their hands. They may have had a situation like a death in the family, or some kind of disability. in some cases, they may just have a partnership that, maybe it's not working well and they want to go their separate ways. And the way to do it is to sell the business. So number one is, what are some of the circumstances by which deals come about for you? And for business owners that are listening, that may be thinking about, looking at you for some kind of a deal, how do they know? How can they tell if they're ready, or should they just kind of contact you and maybe start a conversation, and then maybe you can help them assess their readiness?
Yeah, so I would say the great thing about being a still small investor is that we can work on every single deal like individually. So every single time when I'm having the first initial conversation with the business owners, we are talking about what they want to achieve, because being from outside, I cannot tell them what they should do with their business, right? So I'm always trying to understand what's their next step, what's their goal. And from that point, there's multiple solutions to the same challenges or problems or things that they want to do to accomplish that. So I would highly advise to just have a phone call and discuss with that, because sometimes they want to sell. Going back to the first question that you asked, like, we have two types of distress things that wants to sell. Sometimes the businesses are distressed, something happens and there's cash flow problems, there's a lot of liabilities, there could be problems with the partners and things like that, that put pressure on the business. So that's one thing. But those businesses are usually not that much valuable. It's more like finding the way how to survive and maybe find a way how to thrive again. So we can definitely help with that. Second thing for us, when we are buying the whole companies, is business. That is great, but the business owners is kind of distressed. It could be some illness in the family that you mentioned, which is terrible, but things happen in life, right? Or they are just tired of running the business day to day. They want to move. They want to be just advisor in the company, or just stop working and just hang out on the golf course or something like that. So that's another thing. But there are other things in between. So maybe they are looking to grow to the next level, so they can have the big exit, but they want to have a partner that is able to get into the business, partner with them, sitting on the same side of the table, being a partner in the business, maybe selling or doing some type of deal to giving or selling some part of equity to, for example, to us or somebody else, and partner with them to prepare the business, use the resources, maybe bolt on other businesses, which is first thing that we want to do. If we buy the business, we are looking to other businesses that we can bolt on to that, because then you can doing cross-selling and use the resources and best practices to grow both businesses massively. Sometimes we do a merger or like a roll-up with multiple businesses, because you know very well that if the business is bigger, the valuation will be bigger. So if you have like $2 million business, you might get in revenue, you might get 3 times multiple. But if you have the $10 million business, you can get six times multiple, right? And probably better terms. Sometimes just putting $2 million businesses together and not do anything with that can be better exit for all business owners. Initial discussion, I always say nothing ventured, nothing gained, basis type of discussions, confidential discussion for sure, to discuss what they want to do and discuss what we can do for them, whether it's like some type of partnerships, how to do it together, or just get the offer from us for the business itself. And it doesn't have to be 100% of the business, right? It could be 80%, 70%. So business owner is still in the business and can have another exit when we apply all these strategies, and just don't need to run the business day to day. Maybe doing something that they like while they start the business. It happens all the time. They just want to go back and fix cars and don't deal with the customers, right? For example,
Right.
or they want to manufacture the thing that the business is manufacturing, or working on the construction side, but not dealing and having the risk of running the business day to day and dealing with the taxes. It was COVID before. Now we have a higher inflation. Now there's a war, and I don't know. There's a lot of things, right? So a lot of business owners start to getting tired of still trying to solve these and go through these challenging times, especially if they are running the business for 30, 40, 50 years and it's not growing very much. It can start to be like, hey, where is the next level, right? Like they started the business thinking they will be the next Apple, and after 20, 30 years, they are not. So how they can go to the next level? There's public markets and things like that that we are using. And if you are ready, like that's maybe a good example. I almost bought a marketing agency in Europe with $6 million, and we were pretty close to closing the deal. And at the end, the buyer deciding it's too soon. And I guess he decided it's too soon because he was in the process and he was in the decision making. I'm not telling, call me if you don't want to sell. It will be a waste of time for everybody.
Right.
But sometimes when you start to thinking about it, you will find whether you want to do it or not. And there's other things that you can do to just transition and do it step by step. Because sometimes it's a big step to work 5 times a week, 10 hours a day, and from after 3 months after selling, do nothing, right? It could be a big step. And that's what this business owner realized. So we can work it out. Like we are pretty flexible. I would say that's the biggest advantage from maybe bigger firms, that they have much more stricter. I don't know whether it's word criteria. I need to fit into a couple of boxes. We have pretty flexible boxes, I should say.
Yeah.
So yeah. That's
it.
I
mean, I guess it's a lot to unpack, or what you just said. And a couple of things. One is the flexibility and the fleet of foot that you bring because you're relatively a smaller investor compared to the bigger ones, so you're able to move quicker. The other thing is that there's a lot of different options available, right, in terms of the stepwise kind of thing. People don't have to think, I'm changing my status as an owner overnight, right? So it's not like you're selling, you're done with it, and therefore it may be too big a step. You can start off by bringing on a partner like you, right? An equity partner who can take some things off of your plate that you're not interested in. If you're just interested in the technical side of it, like fixing cars, the example that you gave, then you can handle the management and the sales and the whatnot side of it. And then the other thing is, and then in terms of capitalization, right? You bring in a capital, and then the owner then diversify their risk, so that all their wealth is not in the business. They can put that additional wealth in other places, so they can protect themselves. So just a lot of different options that you bring to the table that owners may not even be aware of.
Yeah, and like I would just like, a lot of people think that money is the cure of all, but it's not. Like just a small part of it. Because, for example, for every business that we buy, we have or partner up or work with, we have like first 100-day plan that we really look at the numbers, and we usually find 15 to 20% of the revenues to turn them back into the cash, grow the profitability, grow the top line, by just optimizing things that people don't. Most business owners, in terms of small and medium-sized businesses, there are more business operators running the business day by day and working on the customer value, and working with the employees. What we do is working on the shareholder value, how to make the business more valuable. So we start to measure things that most business owners don't measure. Sales processes, working on how we can optimize the revenue streams in terms of just doing minor adjustments, but overall it will take a lot of growth in the business. So if your business has 10 to 20% margin, we can usually grow by 50 to 100% the margin in the, let's say, 6 months. We can usually do it much faster, and like just like that, you will double the size of your business. We have strategies to optimize the sales processes, so you can grow by 30-50%. And there's a lot of things that you can do. And if you add the merger and acquisition side, like 2 plus 2 is not 4, it's 6, 8, it's potentially a 10. Right. And that's a great thing to do. So sometimes just I have done the deals in the past that we figure out like giving us 20% of the business will make much more value in the 1 year than doing that. And then we can sell it together, or then we can buy the rest of the 80%, or then we can buy 60%. So we have 80, business owner has 20, or whatever. There are some multiple things that we can do. And it's always based, I never pitch my deal structure, my solution, deal structure maybe yes, but solutions to the business owners. It's always about what business owners are looking to solve and finding a way how to do the transaction that suits them best. And we are able to move really quickly. So we guarantee that you will get the offer from us after sooner than in the 14 days after we receive all the information. So whatever business you want to sell, when we exchange informations, financial, have initial phone calls, and that way we will give you an offer in less than 14 days. So you can just look at it and see whether it's a good fit or not, and then we can work it out whether we need to do any adjustments. So yeah, we are trying to move super fast. In some type of deals, we do a fast due diligence process as well, because some bigger companies, sometimes it happens that they like give you a great offer at the beginning, but then they will do a lot of due diligence and they will find what's wrong with the business and tell you like, this is wrong, this is wrong, that is wrong, that is wrong. And we need to buy you for maybe 70% of the original offer, or even 50%, sometimes even less. And sometimes it puts business owners to the corner that they spend a lot of time talking with this buyer, probably tell everybody else that it's sold, and after 3 to 6 months it's not. The business is sometimes got distressed because they start thinking about the next chapter of their career, right? After selling the business, and not work in the business that hardly, and sometimes the business can be put under pressure. So yeah, we are trying to do it as fast as possible. It depends on the deal. If we need to bring financiers and a lot of money because the deal is great, the business is great, it's different. We need to make sure. But for example, I put down a free PDF when I share a couple of creative ways how to sell business fast. If you need to sell fast, what are the creative structures, how to do it so you win and the buyer win, whether it's us or somebody else. In those type of scenarios, we can move really fast because we need to solve the problems. With the distressed businesses, if they have like a cash flow problems, like you don't have a lot of time to think about, right? Because after 3 to 6 months, there's no business maybe. So we are used to moving like really quickly in the days or weeks in those scenarios. So, and we try to do it in every single deal that we do because we want to do the deal, not talk about the deal for a while. So, because it's time for a lot of people. So yeah.
How do you deal with the owners who may be afraid of losing control? So, I mean, whether they bring you on as a minority partner, or whether they flat out sell the whole 100% equity to you. Sometimes owners, well, if they're not selling it outright, they may feel like, hey, they may be losing control at some point. So how do you assuage them of those kind of fears?
Yeah, again, it goes back to the initial discussion of finding the way how to do it. For myself, I love deals that business owners want to stay in the business, having 20%, having some part of it, doing what they love, being as a consultant for the buyer, and joint venture to make the business much better, so they can stop working day to day, have less stress, whatever they want and cheer us from the sideline or a little bit in the field, and working together so they can see the business to the next level. Like we always promise that we will not fire employees. We always promise that we will not change the brand. Our goal is always to build upon the legacy and the brand and the culture that the business owners built over the years. So sometimes I feel business owners, if they are looking to sell, they are afraid. And there was a studies done in the past, and most small and medium-sized business owners, their biggest fear wasn't that they will not get the best valuation. The biggest fears were about destroying the brand, destroying the employees, and things like that, so that the business will be destroyed after the acquisition. So we can guarantee those type of things. We never want to do that. We want to build upon that. And but yeah, it's like it's a business. There's a lot of fears and emotions involved. So it's about the discussion. But yeah, if you want to have the exit in the future, now or in the future, you'll probably need to at one point give the keys to another person. But that's the thing, like find the buyer that suits you best.
Right.
Don't just look at the valuation. Look at the valuation. Sure, the offer, sure, it's important, but look at what the business buyer is bringing to the table.
Right.
Whether their plans with the business is the plan that you would like to see in your business, how they will deal with the employees, whether they will let you help them in transition, maybe stay in the business, maybe keep some part of the equity so you can stay in touch. And after the changes, you can have the upside from the things that the new buyer or the buyer will do and things like that. So that's great about the business. There's a lot of moving parts, and you can always find a way how to structure it that way that it suits everybody.
Yeah, and I'm glad that you touched on that, because a lot of times culture and the employees are such a big non-financial, part of the non-financial aspect of making these deals. And sometimes owners forget to ask until afterward, and then there's a lot of raw feelings afterward, because employees may feel like the owner may not have looked out for them after they've helped them all those years, and the owners may feel guilty because maybe they didn't know, because a lot of times this may be the first time they engaging in such a deal, right? Because they're used to running their businesses, they're not used to making deals. And so that experience may be lacking unless they have like an advisor who's helping them navigate the waters.
I would also look at the bright side of the thing, because if those employees working in a still small, medium-sized business, there might be a upper level of their career because it's a small business. But if you, for example, sell it somebody to like us, that we are building a group of companies that we can take public or bought on and bigger companies, those employees can actually have another steps that they could explore after the transition. So it could be advantage. I don't know, if we bring 3 companies in the one sector and take it public, then they can have a public stock and things like that. Like we a couple of times discussed the deal structures where employees were involved in the deal structure. So we basically the key employees were joined the acquisition and buy portion of the business as well,
right?
And things like that. So if there's a couple of employees that are or management team, like we can structure a deal. I like the business acquisition where the business owner stays involved, but the business owner is not looking to stay involved, but say, hey, we have 3 employees. We have built it together. They were loyal. I would love them to have either part of the money that they will receive for the business, or keep some part of the equity. Like, we are happy to do that. Like, if it's the thing that will be the most important thing to make the deal and solve everybody challenges, problems, and things that they want to accomplish, the outcomes, like, why not? Like, it will be no-brainer to turn it down. So, or maybe some businesses have the employee funds, right? Something like that. It could be turned into the part of the acquisition mix, so they can buy part of the business. Sometimes it happened to us that they told us, like, hey, I have that amount of money in the retirement account or private account. Can I join you and give you equity so I can be partner in the business? Like, we have dealt with these type of scenarios as well. So yeah, make them the partner, make those employees the partners with you as a business seller, and make it the partners with the business buyer as well. So everybody wins. That's the beauty of doing those type of deals and thinking about the outcomes, not necessarily just about the monetary stuff, because that's the difference, right? If you look at the acquisitions and mergers in the public companies, it's completely different, because there are one set of advisors and the second set of the advisors dealing on behalf of the shareholders, right? No emotional attachment, just bonuses, just whether you will have a CEO, CFO, or nothing on your business card, and things like that. In these smaller deals, we are talking about business owners, managers most of the time. And it's a lot of emotions, a lot of things that are outside of the money, outside of the valuation, outside of things like that, that we need to take into the equation and work the deal that works for everybody.
Yeah, and which is why it does take time, because you got to take it, you have to reflect on things, right? Like how far you've come in your business, and what you really want, what you're trying to do in the next phase of your life after the deal is done. What will that mean for your employees and your management, and how do you get them involved? That whole thing, that takes quite a bit of time to kind of work through that, right?
Yeah, sure.
So, I mean, in terms of the deal structure, right? So, there are things where you talk about the deal structure. I'm curious to know, typically, just the decision-making criteria, how things normally flow into different channels, different options. One is 100%, sell, right? And then the other is, like you break it apart. So maybe you say 40% cash up front, maybe 40% you get like a notes, like a loan, for like the next 3 years or something. And then maybe the last 20% is an earnout, meaning you have to work and meet certain performance targets. So in general, obviously, specifics are going to depend on many variables, but in general, what are they like general rules of thumb for when, which option becomes more attractive or, get taken?
Yeah, again, it depends on the discussion, because if, for example, it's a retirement sales, it might be tax efficient and even beneficiary to do much more seller financing. Like, sometimes people are not looking to do that because they feel like they will wait for capital, and it's better to have something in their pockets now than in the future. But if they are looking to retire, that might be great, right? So it depends. But yeah, if I look at it in terms of the business itself, like, it depends on the assets of the business. If the business has more assets, like invoices, things like that, it will be more the cash that it's not used for running the business. It's not working capital, it's excess cash. It will put more money into the initial like a price, the down payment, let's call it. The earnouts, it's usually, I don't like them very much. And I know some businesses, like, to be honest, not for now, like in general, like, most small and medium-sized businesses, there's a lot of value that is for the future. And with the business owners, there's not guarantee that future will be the same. So a lot of times, a lot of percentage of the value is linked to the future. And a lot of business buyers will do very small upfront and a lot of earnouts. And we have businesses like that, and we are not able to pay near close to 100% cash. That's happened. But we much rather prefer the like a guaranteed seller financing than the earnout. We use earnout basically just if I say like I see the value $1 million and you see the value $2 million, I would ask you like, where is the next $1 million? I don't see it, let me know. And they could say like, hey, yeah, because if you do this and this and that, then there will be more like $1 million extra. That's the potential, that's the upside that will happen after the acquisition. From that perspective, it should be the upside of the buyer, right?
Mm-hmm.
Not the seller, because the seller will be gone. Yeah. But the earnout, from my perspective, is the way how to partner up on the upside and say like, hey, okay, you see the $1 million extra valuation. If you do this and this and that, we are happy to give you the $1 million extra. So at the initial, with the initial price, the equity, the initial valuation, we want to use these type of things and things that are addition to that. Like that's a great way how to use earnout as a bonuses if the business grows and the seller can help. But like it's hard to talk about it in general because it will depends every single time. And as I said, like we have really easy 3-step process how to get offer from us. You schedule the initial conversation with us, having this discussion. We exchange the information about the business and we give you an offer. It's that easy, like nothing else. There's steps behind those 3 steps, but there's the 3 major steps. We have the initial conversation, we exchange the information, and we give you an offer. If you love it, great, we will do due diligence. If you don't love it, we can negotiate, but that's like the 3 steps. So, and from that, in the offer, you will get specific deal structure that you see. But most of the times we will discuss what the business owners want at the initial conversation, right? But so it's much easier to experience that than talk about how it could happen, because some businesses are really great and they should get a lot of percentage of the valuation upfront.
Mm-hmm.
A lot of businesses, there's things that need to be done, and from that point we do more seller financing and other things like so. It really depends on the how the business is. More work that you do, the less risk the business is in the business, more profitable, bigger it is, the valuation and the year structure will be better. If it's not ready, you have poor financial records, it's hard to get our head around what's happening. We need to make sure we protect ourselves as well and do more deal structures and things like that. But yeah, we put down offers on the businesses that had real estate involved, and business owner wants to have a real estate, lease it back to the business. They saw the real estate is more valuable than the business because the business wasn't in a great shape, for example, or it was, doesn't matter. Mm-hmm. And he got the same income from the real estate as he had from the business, and stopped working day to day. And it was something that they want to do. So it's not a great answer, but as always, it depends.
Right. So how does a couple of sticking points that have usually come up in deals, and I know we talk about culture and you already kind of took care of that. What about things related to like long-term debt and then also working capital, right? Do you typically find yourself just haggling over that with owners in terms of who's gonna, because owners sometimes may think that the working capital belongs to them, and it's the buyer, is looking at the working capital as part of the asset that they're buying. So yep. How does that factor in? And also in terms of the debt and the asset and the equity, just what is your philosophy on those
Yeah.
aspects?
So in terms of the debt, we usually just inherit it as a part of the deal. That's like a go-to strategy. So business owners doesn't need to go and clear down and things like that, because we will need to find the money somewhere else, right? So we just inherit it as a part of the valuation. In terms of the working capital, that's something I believe that it's a little bit misunderstood because of the business brokers. The working capital is the asset. How the business works. You are buying the assets to produce the revenue. You turn the revenues into the profits. You turn the profits into the cash flow. And from the cash flow, you are doing some capital investment. And then you have free cash flow that you can distribute or use for more investments or pay down debt. That's how it works. So all the assets that are needed in the business to produce the revenue is not another value, another like any addition to the valuation. Because if you say like, hey, we have this working capital, the cash, the accounts receivables, the inventory and things like that, it's $500,000, and then the business is making $200 profit, we want 3 times. You are asking us or somebody else to pay you twice for the same thing. That's the thing that people don't realize. Like, but if there is the real estate in the business that is not needed and could be leased for the business to operate, this is something that is top up for the valuation. If there is some more cash in the business that business needs to operate, that's another top up for the valuation and things like that. But everything that is needed to run the business day to day is the asset that produce the revenue, produce the profits, produce the cash flow. And that way it's like I always say, like, you are just asking me to pay you twice for the same thing. And if I'm telling that way, most sellers don't understand, but that's maybe going back to the things that most business owners are the operators, not looking from in terms of like servicing clients and employees. And it's a little bit different in terms of how much the business is valued and so forth. So yeah, working capital is definitely an asset that is producing the profit. So it's not good to ask somebody to pay you twice. But sometimes I saw the deals that if I put it together, it was still great valuation. So it depends, right? But yeah, working capital is something that sometimes happen. But usually if I'm talking about the deals from the business brokers, if I'm talking with like off-market deals, which is something that we do most of the time, from having discussion with people like you and bringing us the deals, or seeing me on a LinkedIn or something like that and thinking about selling the business, or other sourcing strategies that we use, we are usually talking with the business owners without any intermediaries and things like that. That make it usually much easier to do the deal than with the brokers and things like that. Like, I don't have any problems with them, but sometimes it's make the deals sometimes even not possible to do. Actually, it happened a couple of times. So
right. Yeah, so I mean, I think the PDF and whatnot that you discussed, we're going to have that information in the show notes, so people can have access to that. So thanks for sharing that information. Right. So I want to kind of bring it to a close, but last question I had was, I mean, you mentioned like growth, you also mentioned risk, and then you mentioned cash flow. In terms of what you're looking for now, because one of the good things is that this is basically kind of like a live exercise. You actually looking to buy certain companies, and it's just like, people can have a checkbox to see if they meet some of these criteria. Is there like a specific like range of growth that you're looking for, a specific type of risk profile that you're comfortable with, a specific type of range of cash flows or directional cash flow that you're looking for? You just looking at it for what it is, and based on it, determine what the alpha should be.
Yeah. So the second option is the right one. That's sometimes it's like just the personal assessment. It's not like a specific. Sometimes it is, but if like a business has 80% of the revenues from the client, that's a big risk factor, right? And it's easier to spawn, but sometimes it's not. So yeah, we have our own valuation and our forecasting that we do for every single deal. And our goal is to give offer for any business that is looking to sell, to give them the options to decide whether it's the right deal to do or not. And from that perspective, we are more creative on the deal structure and things that basically the problems that we find or the challenges that we find in the business. We usually don't say no. We just say this is something that needs to be handled. From that perspective, there is some more risk. From that perspective, that's the upside that we will see and we need to cover. And from that perspective, maybe we are not able to give you that much money up front or something like that.
Right.
But yeah, like sometimes I like more companies that has 10% profit margin more than if they have 40 or more, because if they have 10% profit margin, we can usually double it in 1 year and things like that. So some things are opportunities that we can explore. Like, again, it depends on the specific deal, but yeah, for us it's important the revenue and the profits if we are looking to buy. If it's distress over 500,000, it's like a minimum. If it's other types of deals like looking for investor or distress type of deals, we will go a little bit lower. If they want to sell, we need at least $1 million in revenue and 100,000 of profit to be able to give them like a real offer. And we have some upper limit because over $10 million, there's more competition. So we don't want to compete that much in that realm. So 1 to 5 million is the sweet spot. $1 to $10 million. So it's the revenue range for these type of things. With the bigger businesses, we do other things like public markets, helping them to buy other businesses to grow and things like that. So every business owner that is looking to grow, turn around, sell, we can have the discussions how we can help. But in terms of buying those businesses, these are the criteria. And from having these discussions, having our own valuation, getting the information and the data, we will put down the offer that we feel it's a fair. And after that, we will have a conversation to find out the final deal that will make sense for everybody involved. And we can discuss how to add the employees, suppliers, or seller to keep part of the equity, real estate that they have in the business, and other things like that. So yeah, still trying to be creative and flexible to do rather more deals and solve more business owners' problems than just be strict and just say no 1,000 times, and then some unicorn like appear from the forest and we say like that's it. Like, yeah, with the small and medium-sized businesses, it's I believe that's a better approach to do. Like, if you look at the statistic, like just less than 10% of the businesses are ever sold, and that's the reason why. So I sometimes work with the business brokers and say, if you didn't take some deals to sell because it's not a great profit, revenue, cash flow, like just refer it to us. We will probably find a way how to handle it, and just be creative and find the ways how to do it, not how to decline it. Like,
right.
That's our approach.
Yeah, glass half full. Wonderful. So again, the 3-step process: they need to contact you, you have that conversation, you exchange information, and then you make the offer.
Yeah, that's it. Easy.
Wonderful. Well, thank you. And how do people get in contact with you?
Yeah, so as we discussed, like there's a couple of links that they can look at,
right.
And hopefully they will find it somewhere around the video or the podcast or anything. But the major website is my personal one, so krystofbartos.com, krystofbartos.com. You can find me on LinkedIn. I am very active on LinkedIn. We have wrote a couple of ebooks and PDFs to share our knowledge that we use for every single business that we buy or partner up or work with. So then you can decide whether you want to apply those strategies by yourself, or you want us to partner up with you to help you to grow to the next level, turn around, or sell or prepare for sale, take public, and things like that. So if you can, like, share those links so they can they can find more informations. Yeah, and if you find me on YouTube, I have a couple of videos, not a lot, but on YouTube, but there are a couple of videos on my name as well about last time I discussed how to manage your business during inflation, because that's the big challenge right now for the businesses and things like that. So yeah, a lot of options to get in touch. And yeah, and on the website, if you want to have the initial conversation, at the top part of the website, there's like a scheduled phone call, so you can do it and you can have a discussion.
Yeah, that's great. And yeah, like you mentioned, we're going to have that in the show notes, and they can also go to www.infhorizons.com/podcast. And we live stream, we simulcast this thing over there too. It's delayed, but we're going to have that information over there. Well, thank you for joining us this week, Krystof, and look forward to speaking again soon.
Yeah, thank you very much. Pleasure to be here always.